So if you need an image of a famous person, Churchill, Lincoln, anybody famous, Mother Teresa, would you go out on the internet and pay for the image to use in your publication, or would you just use AI? The fact that more people would move toward AI is having a huge impact on two companies that supply these images and make money from them. And it's a great way to talk about returns on investments. So this is a recent article from Forbes, The Future of Stock Media, meaning stock photographs, after Getty and Shutterstock join forces. So what we learn here is both these companies are publicly traded. Getty Images and Shutterstock announced a merger of equals. Combined enterprise value of $3.7 billion. It just happened a few days before this recording. And it says in the article, it comes at a critical juncture where stock media companies has faced disruption in recent years, mostly because of AI technologies. Because as I said in the intro, you can go out and find an AI generated picture, not pay much or anything for it, rather than pay the big fees that these companies pay for their images. Let's look at where these companies stand now. So here's Getty Images. If you Google a stock with the stock symbol like what I did, usually the first good reference is going to be Yahoo Finance. So this is what I want to point out. If we look over here at profitability, their profit margin's a little under 6%, return on assets about 5, return on equity about 8. That's going to be important in a minute. Let's go to Shutterstock. Same thing. Here's the stock symbol, it's Yahoo Finance. If I scroll down, they are going to provide the same sort of stats here. So their profit margin's a little lower at 4%, return on assets is lower, it's a little over 5, return on equity is a little bit lower, it's a little less than 7. So that's where they stand. Both companies are going to merge. They have similar profit margins, similar return on asset and return on equity. So here is a whole list of profitability ratios, a few that you saw in the prior slides and discussion, and some new ones. So what are we looking for as an investor? We're looking for a return on our money. It doesn't matter if we're buying a lemonade stand or gold or anything, a house, we're looking for a rate of return. So the ones that we saw in the prior slide, return on equity. So you're a stockholder, you own common stock. Is net income less preferred stock dividends, because we're going to take out any obligations to pay dividends to preferred stockholders. They come before common stockholders. So we're going to subtract that out, divided by average equity, really average common shareholder equity, because this tells you for every share of common stock, how much money are we making? So that's one measure of profitability. Another one was return on assets, which is simply, we've got turnover on assets up here, which is similar, which is what kind of return are you making on all the assets that you bought? When you invest all this money in your business to buy assets, those assets are bought. They're a resource to create revenue and profit. So how efficiently are you using assets to make a profit? That's return on asset. Earnings per share. If you're any sort of an investor, you've probably heard of this one. Net income divided by preferred stock dividends divided by average common shares outstanding. It's a variation on return on equity. Again, how much for every common stock share is the company earning? And then dividend yield. Companies may or may not pay a dividend. If a company is consistently profitable, they may take some of their earnings and pay a cash dividend. Well, how does that dividend look and compare to the price of the common stock? That's what dividend yield is. Annual dividend per share in dollars divided by earnings per share. And you can see some other measurements here. I like the last one at the top, which is net margin, which is for every dollar that you sell, how much profit do you make? You could also say it as profit margin. So net profit or income divided by revenue. This is a great measuring stick to compare, make an apples to apples comparison between companies that have very different levels of sales. Because the bottom line is, if you're at the hardware store and you're selling lawnmowers or hammers, they're priced differently, they're different products. How much money are you making for every dollar sold? That's what net margin is, or profit margin. So profit margin, return on equity, return on assets, some really important metrics. And what Getty and Shutterstock are trying to do is to increase those metrics by combining, removing expenses for duplicated work. They don't need two sets of accountants and lawyers and home office people and marketers, and they can get a higher return on assets and investing. So the takeaway here is that AI is going to create all kinds of disruption in all kinds of industries. And when industries are disrupted, you're going to see companies merge and consolidate to remove duplicate costs to maintain returns on investment and assets as their businesses shrink and competition increases.